So I have a three-part plan to help you get a loan with a low or a bad credit score. Number one is to pick your timeline. Number two is to understand the core problems. And then number three is to start taking action. I've personally funded loans for people all the way down to a minimum of a 515 credit score. One of the kindest people I've ever worked with as a buyer was a disabled vet who's about the same age as me. He had a 515 credit score because of some past medical debt and some other things that he wasn't able to keep up with, again, because of that disability that he had. We were able to get him into a VA loan, 0% down, 0 monthly mortgage insurance, a fantastic interest rate, all with a 514 credit score. Okay, so number one, we need to pick the timeline. There are two main timelines that you might be running into. The first one, this option is a bit faster. Okay, this is the fastest option. And this is to buy a home right now with low credit. We'll talk about, again, what that means and some strategies here. But you buy now, then you build credit while you're in your home, and then you can refinance into a cheaper loan, because often when you buy here in the beginning, you will run into an issue where the interest rate might be higher or the terms might not be favorable for you. Then number two is to look at building credit first and then buying. And this process is slower. All right. So you want to pick those two timelines, what works for you. And we'll explore through this video. You'll start to understand which one might be best for you moving forward. After you pick your timeline, then is when you want to understand what's the core problem, because we can talk about and say like, okay, I have bad credit. Well, what exactly about the credit is bad? Because there's something specific about your credit history that's holding you back from purchasing a loan. It's not that you just have this vague idea of bad credit. Okay. It's not, there's good credit and there's bad credit. There's credit amongst all these ranges, and they each have different stories and components that we need to figure out. So sometimes I hear people talk about this idea of like, well, the system is just rigged to get me. And it's really not, because mortgages have rules. Just like if we played a game of Monopoly, it has rules. To win the game, you have to follow the rules. And so this video is just explaining to you, these are the rules that you need to follow to get a loan. It's not about who you are as a person. It's just simply your current situation, your current credit might be outside of the rules. And so of course, you're not going to be able to play the game if you're not playing by the rules. I'm going to teach you what the rules are so you can figure out how you can actually play the game, pass, go, or do whatever is in Monopoly. I haven't played that in years. So understanding the core issue or issues that are going on with your credit, that's going to help you create a plan moving forward. That way you can talk with a credit coach, or you can figure out your timeline, or you can talk with a lender and say, I know this is what's holding me back. But until we know exactly what's holding us back, we're going to feel like everything's stacked up against us. We need to know specifically what the problem is. So first, let's talk about the minimums, because this is the first problem that you're going to run into, is there's minimum credit scores with each main loan type. So here are the four main types of loans: conventional, FHA, VA, and USDA. So conventional, minimum credit is 620. Conventional loans are super difficult to do if we have rough credit. Even if we have a 620 plus, let's say we have 620, but we have some missed payments here, it might be difficult to qualify conventional. FHA is then the most common that you'll see in the low credit score or bad credit space, okay? And so there's two different minimums, and this changes the down payment. So FHA goes all the way down to a minimum of 500 credit score. Now, not all lenders do that, but that is the base minimum score, and so we can work to find a lender that uses a 500 score as a minimum. So if we do 500, the down payment is 10%. All right. If we have a 580 plus, then the down payment is 3.5%. So you can see the down payment changes based on the credit score. So right here, you might be thinking, well, I can only afford 3.5% down, and so my credit score is maybe 560. All right, so there's our first issue. We need to work on getting the credit score up so we can afford the smaller down payment. VA and USDA are two other options. VA goes down to 500 and USDA goes down to 500 as well. These are a little bit more niche, because VA is only for veterans. USDA is only for rural areas, and there's an income limit as well. So they're more restrictive. That's why FHA is going to be the most common, and we'll talk mainly about FHA here. So VA goes down to 500, although most lenders won't do VA unless it's 620. It's kind of an overlay that they have. It's just a rule that they want, but there are still lenders that do down to a 500. Again, I've funded a 514 as the lowest credit score loan that I've done on a VA loan. USDA goes down to 500. However, this has to be manually underwritten, whereas 640 allows you to do automated underwriting. And I'll explain that here in the future of this video. So your credit score is half of the story. And sometimes I think that's where we get tripped up, is sometimes I talk with people who have a 640 or 680 and they still have issues getting qualified because, again, credit score is only part of the story. It's only one number. The credit score, the other half, is why is the credit score there in the first place? Were there events that caused the credit score to get there, or that caused there to be more to the story than just the score itself? And so these can be things like a bankruptcy, a foreclosure, a short sale, a deed in lieu of foreclosure, any collections accounts that you have, missed payments, medical bills. These are things that in tandem work with the credit score. So the credit score is going to just show a number, an overall number about what's happening, but it doesn't tell the details of the story. Mortgages are interested in about the details of the story along with the number. So we might have, again, above those minimums, we might have a 520 credit score. Great, we can qualify for an FHA loan if we have 10% down, but we might have had a bankruptcy that was super recent, and that keeps us from qualifying. So that's something we have to watch out for. So here are the waiting periods for some of these events. So deed in lieu of foreclosure, it's a 3-year waiting period. If you have a foreclosure, it's 3 years as well. Even if the foreclosure was included in the bankruptcy, you have to use the date of the foreclosure and not the date of the bankruptcy discharge. For a short sale, it's 3 years. For a Chapter 7 bankruptcy, it's 2 years from discharge. For a Chapter 13, this one's a little bit tricky. Basically, the rule is 12 months of on-time payments and court approval, and that qualifies you for a manually underwritten loan. For an automated approval, which is AUS, you have to have a minimum of 2 years waiting period to be able to get an FHA loan. Okay, mortgage lates. Again, if you're doing an automated approval, you can have up to 3 30-day lates, 1 60-day late, and 1 90-day late. However, automated approval doesn't often give an approval on those numbers. Manual requires 12 months of no mortgage lates. Okay, so that brings us into 2 types of underwriting. If you have bad credit, you're going to be exploring 2 different types. Okay, most people aren't familiar because they go through automated underwriting. And basically, automated underwriting or automated underwriting software (AUS) is when a computer software says you're either approved or refer, which is basically the computer can't approve you. So computer software is going to take in information from your loan application and information that your loan officer put in there, and it's going to basically say thumbs up or thumbs down to the loan. And most lenders like to see the thumbs up because that's the easiest. It's easiest when the computer can evaluate the loan based on its risk profile. However, when the computer can't, it gives a thumbs down to where it's going to say refer. It's not going to say deny, it's going to say refer. And so when you have this refer, it's going to push you into manual underwriting. And manual underwriting is basically where instead of the computer software giving a thumbs up or thumbs down, an underwriter themselves has to comb through tons of details about your credit and your personal situation to see if they're going to be willing to give you a loan or not. And so the criteria for the loan becomes a lot tighter. And you're often running into higher interest rates because these loans are more risky than if a computer approves it based on its risk profile. So you may be running into this if you're getting a loan with bad credit. All right. So with manually underwritten loans, since the computer can't approve it, they want to look for what's called compensating factors. So basically, what things can offset? The computer said no. What can we show that gives the underwriter a better feeling that we can pay back this loan, even though we didn't get approved by the computer? So a huge thing with manually underwritten loans is 12 months on-time rental payments. Right? So here's another thing where we can spot issues. If you've been late on your rent, you're not going to be able to qualify for a loan. Unfortunately, we're going to need to extend that timeline until you have 12 months on-time rental payments. That's huge for manually underwritten loans. Also reserves. Normally, this is 1 to 3 months worth of reserves, which is if your future housing payment, your future mortgage payment is going to be $1,000 a month with taxes, insurance, and everything, then you need to have $1,000 to $3,000 extra in your bank account after you pay your down payment and closing costs. That's what reserves are. Basically, the lender wants to see that you didn't empty out your bank account to be able to qualify for a loan. They want to make sure once you pay down payment, closing costs, you can still afford the monthly payment. They're also going to put a limit on the late payments that you can have. And this is going to depend on the lender and the type of loan. But for instance, they might say we only allow 1 installment late in the past 12 months. Or maybe they say 0 lates on a revolving account. And so it's going to depend, again, by the lender, their overlays, and the type of loan. So you'll want to talk to a loan officer that I suggest here at the end to figure out what's going to be required there. And there's also limits on the debt to income ratio. Okay, so how much debt you're able to take on. If you're going with automated approval, if you're able to get approved by the computer software, you can often take out a lot more mortgage than if you get a manually underwritten loan. If you do manually underwritten, it's going to shrink how much you're able to take on as a mortgage payment. So here's a chart here. This is FHA compensating factors that correlate with the credit score and the debt to income ratio. So it can be a little confusing for a second, but I want to work through a scenario here. So let's say, for instance, let's say you have a 580 credit score and loan officer runs your loan through the software and it comes back and it says refer. It says, hey, can't get approved. Okay, so we need to go manually underwritten. So 580 credit score. All right, so we know, let's first look over here in this left column, 580. Okay, so we can do any of these three. All right, so now what we can see over here is these are the ratios for the loan as well. How much debt can we take on our loan? And so for some people, this might be perfectly fine, right? 31%, 43% debt to income ratio. If you're curious about debt to income, what it is, I have another video on how to figure that out for yourself and how much debt to income ratio you need. But basically what this is saying is if you have a 580 credit score, we're doing a manually underwritten loan. And as long as our debt to income ratios fall within this range, 31% front end, 43% back end, then we don't need any compensating factors. Okay, great. We don't need anything extra. All right, we have on-time rental payments and everything else should be good as long as we don't have any extra lates that the lender doesn't want to see. However, if we need to stretch this a little bit higher, maybe we need to go to 47 instead of 43, we need one of the following: verified documented cash reserves, minimal increase in housing payment, or residual income, which is a different calculation we won't get into. But maybe, okay, so we went up to 47%, so we need cash reserves. Or maybe we need to go up to 50%, so we need two of the following. Maybe we need cash reserves and minimal increase in housing payment, okay? And so your lender can help you specify what this is. But basically what we can see here is there's this correlation between if we need automated approval or manually underwritten. Okay, then we can follow in the next step. Manually underwritten loan, where does our credit score need to be for how much debt to income ratio we need? Okay, once we're in there, what kind of compensating factors do we need? So it's kind of this kind of flow chart that goes down that you can see with what is the issue that is stopping you from getting a loan, because a lot of people aren't familiar with this. And again, it sounds like, why do I need to know all this? Well, you need to know all this because you need to know, why aren't you able to qualify for a loan? Is it because you're not meeting the minimum credit score limit? Okay. Is it because the software didn't approve you? All right. Is it because of your debt to income ratio? Is it because of compensating factors? There are things stopping you from getting the loan, even though that you might be able to get around if you understand what the rules are of the game. That way you can come to a lender and say, hey, I know I have a 520 credit score. I only need this amount of debt to income ratio and I have these compensating factors. That's going to help you get a loan, get that processed through, instead of a lender just saying, yeah, we don't do manually underwritten loans, and then pushing you off somewhere else. You need to come in with it to the table knowing exactly what you need. That way you can get this pushed through easily, because unfortunately, a lot of lenders just don't do manually underwritten loans, or they're not familiar with them. I started doing them because, I was coming across, starting new, I was coming across a lot of people who I wasn't able to get qualified through underwriting software. But at the same time, like, I didn't want them to not get a loan, and I also needed a paycheck. So I was like, I'm going to figure out the rules of this so I can help people get into a loan the way that they want to, and help them get through the rules, helping them understand it so they can qualify for a mortgage if they want to. Okay. Step 3 is to start taking action. So you figured out, what is your timeline? Maybe you wanted to build credit first. Cool. And then buy a house. That's perfectly fine if that's what you want to do. Or you want to buy a home first, then build credit. Great. That's what this video is about. I'm not here to tell you what you should or shouldn't do. That's up to you. You're going to have to do your own research on what you want to do moving forward with your timeline. So you did that. Then you figured out, what is the core problem? What's the main thing that's holding you back from qualifying for a loan? That way you can start taking action, which is step 3. So don't let credit get in the way and then just sit back and mope. And I see this happen so often where it's, yeah, there are things that happened in the past, whether it was something that you did or something external that happened, and your credit's in a place where you can't qualify. Instead of just sitting and feeling defeated and saying like, everything's against me, I'm just not going to do anything, and complaining, like that's never going to get you to where you want to go. If you have a direction that you want to head in, you have to do the things to go in that direction. You can't just sit and be idle and expect things to change around you. So expect work. You're going to be working on your credit. You're going to be working through this loan process. This loan is not going to be easy, right? There are countless people that have been able to get approved through mortgages with less than a 600 credit score, anywhere between 500 to 600. But they're not easy loans to do. right? They're going to require work. They're going to require paperwork. It's going to be frustrating and exhausting. Just expect that to be par for the course, right? They're not easy loans to do. And you're going to be working with lenders who may be slower because they take on loans like this. So just expect it, right? When problems come up, of course there's a problem, right? I don't take it personally. This is just part of the rules of the game. We have to follow the system to be able to get what we want. All right. Also explore manual underwriting, right? There's no way I can make a video that's short enough to explain all the different intricacies of manual underwriting for all different types of loans. But I'll have the handbooks, the guidelines that lenders use for FHA, USDA, and VA in the description so you can check those out. Again, read through those, see what is the problem that's keeping you from qualifying a loan. See if there are compensating factors you can use to help yourself qualify. Also, possibly look at working on a credit plan. Right? Maybe you want to do a hybrid of those two timelines. Maybe you want to work on credit for the next 2 to 3 months and then buy a home. Maybe you want to buy a home now. Maybe you want to work on credit for a year before you buy a home. Either way, it's usually beneficial if you have bad credit to work on things to improve your credit. So look at something like a company like My Credit Guy. I really like. I don't get any affiliates or anything from them. I have tons of videos on this channel about building credit. And basically what we're looking to do with credit is you're wanting to tell a better story. Your credit score tells a story about how you handle debt and how you pay back debt. If you have bad credit, unfortunately, your credit history has been telling a bad story about the way that you handle money. Again, whether that was your fault or someone else's, doesn't really matter. It's in the past. At this point, we're working on a plan moving forward. A bad story has been told. What we need to do is now tell a better story, right? There's no good story that's just bad the entire time. A good story includes some bad and a lot of good. So if we're at the point where it's just some bad, let's start seeing what we can do to tell some more good story, more good ways about how we paid back debt, how we are now making on-time payments even though some were late, how we reestablished good money patterns after a bankruptcy. Those are the better stories that we need to be telling. Also consider tracking your credit score. That way you can see, is the work that I'm doing changing the momentum of my credit score? Is it continuing to go up? Is it staying stable? Is it going down? Are the things that I'm doing, the practices that I have with my money, actually helping me getting closer to qualify for a loan or qualify for a refinance that saves me more money in the future? There's tons of free ones out there. myfico.com is the most accurate that I've seen. However, you can use any of the free ones. myfico.com is like, I think $40 a month. So you absolutely don't have to do it. They're not an affiliate. I'm no way connected with them, but they are the most accurate if you're interested in that. And then here are some lenders that I would recommend, because often I make videos like this and people are like, who do I talk to? Everyone I've talked to has said no. So I have no affiliation with any of these lenders. I can't vouch for them. And I have no relationship or connection or affiliation with them. I just know that these lenders do have the potential to help you if you do have bad credit. And the main reason why is because most of them are brokers or they're servicers that allow lower credit scores where most don't. For instance, a lot of big companies will cap or will put a minimum of their credit scores even at like 620, some even higher. So a company like Nexa Mortgage, they're a broker, so they have a wide range of options to be able to explore. They can connect you with lenders that go down to a 500 credit score. Gaston Cho, also a broker. Great educational resources online that they can shop around and help you find a lender down to 500. Carrington Mortgage Services is often who I would use as a broker, and I would direct clients to them and basically broker loans through them. So there is usually no cost difference between if you're going direct through Carrington or broker. Often going broker actually saves you more money than going direct. So these are some options you can explore. I would start here and see if you can connect with somebody who can help you out, right? You don't have to take no for an answer, right? If somebody says, hey, you're not able to be qualified, great, let's move on to somebody else. Let's see somebody who can help us. At minimum, we need somebody who can help us get on a game plan. We don't need somebody just to say like yes or no to us, right? We want to either be yes, here's the work we need to do, or no, here's the work that we need to do to be able to get you into the home that you want.